Over 75% of retail investors lose money in the stock market. If you take inflation and opportunity cost into account, over 95% people fail to make profits. And yet, I am here to make the claim that stock investment is not rocket science and all you need to beat the market is some common sense. Hi, my name is Gaurav Kukreja. I am a popular investor on eToro where I have profitably managed investments worth millions of US dollars for thousands of investors over the past 6 years. You can find the link to my eToro portfolio in the description below. The easiest way to invest money in the stock markets is by dollar cost averaging on the S&P 500. This means investing a fixed amount of money periodically and consistently in the index. By investing in small chunks and not all at once, you eliminate the risk of bad timing. By buying even when the market is going down, you lower the average buying price of each unit of your asset. The S&P 500 consists of the largest 500 companies in the New York Stock Exchange. Since its inception in 1957, the index has stood the test of time and has generated an average annual gain of 10%. Now, although 10% sounds modest, over 95% investors fail to beat the index. This is why the S&P 500 is used as a common benchmark to judge the performance of a portfolio. In my opinion, though, it should be very easy to beat the index. The real reason people lose money in stock markets is because they set out with unrealistic expectations, overcomplicate things, and trade too much. Now, clearly, there is no reward without taking risk. With increasing risk, the potential for reward grows significantly at first. But beyond a point, the incremental increase in the potential return diminishes for each additional unit of risk assumed. Meanwhile, the downside risk or the potential of loss also increases with risk. If you set off with unrealistic profit expectations, you are tempted to take higher risks. You may get lucky in the first few trades, but if you keep up with the high risk attitude, you will eventually revert to the mean. Moreover, early losses are very hard to recover from. For example, if you lose 50% in the first year, you will have to gain 100% in the next year to barely break even. This is a vicious cycle that leads you to take on more and more risk. Retail traders also tend to overcomplicate things. YouTube is filled with financial influencers who claim to be able to identify patterns in the charts that tell them when to buy and sell stocks to beat the market. The human brain is prone to look for patterns even where none exists. It is quite easy to prove with backtesting that these pattern seeking techniques do not deliver results. If there were patterns in the data, computers would be much better and faster than humans in identifying and exploiting these patterns. Moreover, as soon as a pattern is widely recognized, it would cease to exist. For instance, if everyone believes that stock prices tend to be lower on Thursdays, then everyone would wait for Thursdays to buy stocks. This would push the stock prices higher and not lower on Thursdays. The other thing you can do to quickly lose money is by trading too often. The stock prices are unpredictable in the short term. Day trading is a lot like gambling, and the house always wins in gambling. Every time you trade, you lose a small percentage to transaction fees and spreads. These costs can quickly add up if you trade too often. My common sense investment strategy is built on simple principles and basic facts. It has consistently beat the S&P 500 index while maintaining a low risk profile. Here's how it works. We've established that S&P 500 is a good place to start. The index is made up of 500 largest companies weighted by their market cap. This means larger companies have a larger impact on the price of an index. When the index goes up, most often it is due to a small percentage of companies that are outperforming the rest. In my opinion, it should be easy to identify these outperformers by simple research. Around 60% of my funds are invested in these companies. The next 30% of my funds are dedicated to companies that have a potential to replace a company in the S&P 500. These companies have a proven business model and product market fit and are generally already profitable. The remaining 10% of my funds are reserved for new and innovative companies that are disrupting the markets. They present a high risk, high reward potential. This is also known as the core satellite allocation strategy. The low risk core investment in companies from the S&P 500 help me keep pace with the index, while the relatively higher risk investment in the high growth companies gives me the opportunity to beat the index. Now, let's get into the nitty gritties of how I pick stocks and manage risks in my portfolio. Step 1: Research. You don't need to search far and wide for stocks to add to your portfolio. You can start by looking at the products and services that you use and like. You can also look at companies that are doing well in your field of professional expertise. The first thing I do is study the balance sheets and earnings reports of a company. This is not as complicated as it sounds, trust me. Here are the key things I look for: assets and liabilities. Assets are things the company owns, like cash in the bank, inventory, intellectual property, real estate, machinery, and so on. Liabilities are costs owed by the company, such as employee salaries, payments to suppliers, and short and long term debt. To keep things simple, if the company were to get liquidated today, the bank will sell the assets to pay for the liabilities, and the remaining money will be paid back to the shareholders. This is known as shareholder equity. Assets and liabilities are categorized into current or short term and long term. A company must have enough current assets that can be liquidated to pay for its current liabilities. The current ratio is a measure of the current assets to liabilities, and this should be greater than 1. If this number is too high, this means the company is not utilizing its assets effectively. This may be due to growth stagnation caused by market saturation. The quarterly earnings reports shows the growth trends in revenues and profits. A company with a high growth may demand a higher valuation than a company with the same amount of revenue and profit but slower growth. Earnings per share is the amount of net profit attributed to each share. A more interesting measure is the price to earnings ratio, or the PE ratio, which is the ratio of the stock price to its earnings per share. Let's say if a company has a PE ratio of 10, this means you would pay $10 today for every $1 of net profit per year. Free cash flow is the amount of money left after paying taxes and current liabilities. This money can be reinvested or paid out in dividends. Now, it would be too easy if there were a way to identify good companies just by looking at these fundamentals. For instance, companies with higher growth potential often command a much higher PE ratio. So, it's important to look at other subjective information such as product reviews, pace of innovation, competitive advantages, company leadership, and even things like employee hiring and retention trends from places like LinkedIn. I try to routinely read up as much as I can for companies that I invest in. This helps paint a more clear picture. Step 2: Dollar cost average and diversify. Once I identify companies that can outperform the market, instead of buying a large position in the stock at once, I start with investing a small amount and gradually buying in small chunks. This allows me to reduce the risk of bad timing. I limit the allocation to each stock at around 5% of my portfolio. By limiting exposure to individual stocks, I can reduce the company specific risks. This means I have about 25 to 30 companies in my portfolio. Instead of diversifying across a wide range of market segments, I tend to focus on areas that I understand best, which is the technology sector. This prevents me from being spread too thin. Another piece of insight here is that I avoid trying to pick one winner among competitors. Instead, I try to diversify investments among the top competitors. Most often, when there is an innovative disruption, it opens up new opportunities for all companies. Some companies fail to cope up and take advantage of the opportunities, while others will take their place to compete for the market share. Step 3: Rebalance portfolio. Over time, as individual positions grow, they may exceed their allocation. I regularly secure profits from these positions to bring their allocation down. This keeps the risk exposure to individual stocks in check and gives me the opportunity to apply the profits to other positions. Step 4: Introspect. Now, this is the most crucial step that most investors miss. No one can guarantee to make every trade decision right. We are bound to make mistakes. But some investors have a misconception that they only make a loss when they sell a position in a loss. This is patently false. This leads them to collect underperforming assets in their portfolio while they give up on assets that are outperforming. It is very important to accept mistakes and fix them. I am not afraid to close positions in a loss when I have lost confidence in them. I can then put this money to better use elsewhere. Now, it is important to note that since I do not take short positions, my portfolio is strongly correlated to the S&P 500. This means that in a bear market, my portfolio is bound to draw down along with the index. However, by careful stock picking, regulating overall exposure, adding funds regularly, and dollar cost averaging, I expect to drop slower than the index and recover faster. In fact, this is where most of my gains against the index come from. This is why I see market crashes as opportunities. Now, this is a very simple strategy and it is designed to be so. A simple strategy is easier to execute than a more complex one. The strength of this strategy lies in the execution, of course. It takes courage, consistency, and discipline to follow this strategy. Courage to keep buying even during market downturns, consistency to stay the course and let your efforts pay off, and discipline to resist falling for hypes and FOMOs. I have cultivated these virtues over time, and I believe this approach has been instrumental in my success on eToro. Another benefit of a simple strategy like this is that it gives my copiers an understanding of my trade decisions. I also strive to maintain a very high level of transparency in my regular communication. This gives my copiers a strong sense of control on how their money is being invested. I actively encourage my copiers to question and challenge my decisions when they think I am deviating from this course. If you like my investment approach, you should consider copying me on eToro. For those who don't know, eToro is a unique investment platform that allows you to copy the portfolio of an experienced popular investor like me. When you copy my portfolio, eToro will automatically mirror my investments in your portfolio along with each trade I make in future. You get complete transparency so you can monitor exactly how your money is being invested. You also get full flexibility to start and stop copying whenever you want. And best of all, this is completely free and it does not cost you anything. Please consider using my referral link in the description to join eToro. If you choose to copy me, I recommend starting with at least 500 US dollars to ensure that all my trades get copied in your portfolio. I also recommend you to periodically add funds to your portfolio. This way, you may even exceed my performance. Please feel free to reach out if you have any questions. I am starting a new series here and I plan to upload one video every 2 weeks talking about a wide range of topics related to investment. I would appreciate any constructive feedback you can share with me. I hope you found some value from the information I presented in this video. If so, please consider supporting me by subscribing to this channel. Thank you.